I would now like to welcome to the stage the conference co-chair and distinguished professor here at Fuqua, Doug Breeden.
Thanks, Lee. I can see that siren going off right in the middle of John Mack's talk here in just a little bit, so get ready for that, John. In any case, I've got a few remarks I want to make. If we can pull up that presentation, this is it. All right. I want to give you a little bit of perspective also and some numbers and graphs reminding you of the financial crisis. I worry a little bit that in 2008, actually this is March of 19, and that in March of 2008, Bear Stearns basically was forced into its sale with JPMorgan, so it's been 11 years. And I think of our MBA students as being 26 years old and our undergraduates being 20 years old plus or minus. Take 11 years off that, and they were 9 to 15 years old. So I worry that they may not know some of the lessons of the financial crisis, and that's part of why we wanted to do this today. So, you know, some of the examples of major losses by well-respected risk managers, some of the best in the world, Bear Stearns, Lehman, Fannie Mae, Freddie Mac, they were all highly respected. Citi, B of A, Wachovia, so on, really got hit. First, I saw some of my teachers and friends at LTCM in 1998, and I began to wonder, how could this happen? Now, there are bad people and there are dumb people, but to me, they were both good and they were smart. So this began to bother me. And then when it happened again in 2008 and 2009, and a lot of really top people, including myself, got bloodied by that one. That made me think, you know, what are we doing wrong here? So you'll see that, that I get to some behavioral concerns as well as perhaps trying to figure this out. Some of the data, if you take a look at this, here are the investment banks. Bear Stearns at the end of 2006 was $162 a share. And a couple of years later, in March of 2008, they had to sell to JPMorgan originally for $2 a share, and then it was up to 10. So they basically had a run on the bank that they had to resolve. Goldman Sachs went from 199 to 47. Lehman went bankrupt. John Mack's Morgan Stanley, 67 to 671, you know, down 90%. I wonder how in the world you deal with that as it's going on. What's that? You buy the stock, and it's up to 44 now, right? That's been a pretty good investment from there. And you see, I remember these prices so well because I was trading in these commercial banks. Bank of America was $53, got down to $2.53, and Citibank was 55 and got down to 97 cents, less than $1 a share there before being essentially bailed out by the government Citi there, and so on. And the list goes on. Wachovia was forced into a sale with Wells Fargo. Wells Fargo itself dropped 80% and so on. Fannie and Freddie went to nothing and had to be taken over by the government. Those are some of the numbers. It's incredible. That's the stock market. I thought I'd throw up one on the bond market. These are the yields on different bonds. And we've got here Treasury bonds on the bottom that have the lowest yields. And 500 is 5%, 200 is 2%. So this is 2% to 8%. And then we have AAA rated corporate bonds pay a bit higher yield. And the highest yield would be the BAA rated bonds. And what you see is normally they go up and down together, but in the financial crisis here in 2008, all of a sudden Treasury yields came down, and it was such a scary time that the risk premiums on risky bonds went way up. Well, unfortunately, there were a lot of institutions who owned the risky bonds, and when the yields on those went up, their prices went down, and they lost on that. And if they were hedging their interest rate risk, they were short the Treasury bonds. And those had yields that came way down and their prices went way up, so they lost on that. So they lost on both sides. So whenever you see that widen out like that, it's death to a lot of hedged institutions. You see that happening in 1998 also when LTCM went down, but it was nothing nearly what it was there in 08 and 09. Yield spreads. If you think of the yield that a good institution has to pay above Treasury, in 2006, most of them were like 70 or 80 basis points, which means 0.7% or 0.8% higher than government was what these institutions had to pay. But in 2008, these went to like 20%. So if the government was paying 2%, some of these institutions had to pay 22, and of course their bonds in some cases defaulted, as in Washington Mutual and Lehman Brothers and so on. So you see it in the stock market, you see it in the bond market. And part of the reason we had a problem is that Wall Street normally runs, as was I think said in the video, with leverage, assets divided by equity of 30 to 1. Typically for years. These are the big investment banks, Bear Stearns, Goldman Sachs, Morgan Stanley, Lehman. It's quite normal for them to run with assets that are 30 times their equity. So small fluctuations are magnified by that leverage. So what happened to bank stock prices? This is a comparison that to me is kind of a terrifying one, that this is starting out indexing bank stock prices at 100 at the end of 2006. And comparing it to the Great Depression. And what happened in 08 and 09 is that they dropped by 80%, 100 down to 20 in bank stock prices. The S&P 500 dropped 50%, bank stock index dropped 80%, as much as in the Great Depression. So I heard Ben Bernanke speak at an MIT NYU conference on 10 years after, and he said it was a panic. That's why I use that word without embarrassment. It was a panic. And some of the headlines: credit panic hits historic levels. I've been showing this slide for a little while, John. This was a day that I guess Morgan Stanley was in the news. It says Morgan Stanley shares were down 24%. So this was right after Lehman went down. They were making a run at Morgan Stanley, and one of the questions I would ask John Mack is, how do you deal with that? Would you have 15,000 employees? How do you keep them going? 12,000 something? Unfortunately more. I'm too low. Well, you can talk about that a little bit later. And I remember this one, a terrifying headline: market crash shakes the world. In October, down 24% down in Tokyo, Frankfurt, London, New York. This is October. This is after Lehman in September. This is kind of a second wave. And as if that weren't enough, I remember this well too. In November, that's when it hit the credit markets badly. And I know Jeanne Flood was running Smith Breeden, and November 2008 was an awful month because the credit markets froze up and they were specialists in fixed income, and the prices just plummeted. And I remember trying to mark-to-market portfolios of holdings there, and the market prices were all over the map. You couldn't get a good estimate of market prices. It was a terrifying time. Fear stalks the big economies. You see the drop in the price of oil, equities, treasuries, and jobless claims were beginning to jump. And of course, the unemployment rate jumped from 4% up to 10% in a couple of years there. So how can these institutions with such smart people get hit so hard? I thought, well, maybe it's just a storm of the century. What happened to us here? Real estate prices normally went up by 3 or 4% a year, and the typical fluctuation, the standard deviation of this over many years was 3%. And then we had a down 10% in 2008, which is a 3 standard deviation move, followed by a down 20%, a 6 sigma move there, a 3 and a 6 back to back. So that was maybe you could excuse yourself a little bit for not seeing that. And worse than that, in some markets, it was in Phoenix, Las Vegas, Miami, and so on, it was down 50%. So the average was 30, but there were some that were worse. And not only that, many of those that were worse were the ones where securities had been issued. And if you bought securities, those were the ones you got. So with that kind of fall in real estate prices, single-family mortgages that normally people paid routinely and kept current, all of a sudden spiked up in their delinquencies and defaults. Now, I normally show a few more slides there that goes into that a little bit from my favorite author, who is Laurie Goodman. But instead of showing those slides, I have Laurie Goodman to follow me, and she'll tell you some of her things. Now, and then you say, what happened? And Jamie Dimon of JPMorgan, so well respected, got hit in 2012. And the first estimate, I kind of chuckle as I look at this slide, first estimate was that they had a $2 billion loss. I mean, do you remember what it ended up being? I think it was $6 billion. So they couldn't even get a handle on how big the loss was. And they said, what happened? Well, their chief investment office had done so well for so long, maybe we were complacent, and maybe we were overconfident. So he was perhaps taking some refuge, as I have, in some of the analysis of psychology. And I had, when I was dean, my deputy dean was John Payne, one of our distinguished professors here, who is a distinguished psychologist. And he basically said, you know, that even if they're not bad or dumb, you know, the problem is that because we believe we are smarter than the average bear, we begin to believe that we're not bears. I have a feeling he's talking about us humans. And so he taught me some of the research on behavioral errors that people make. Even smart people, and sometimes especially smart people, get overconfident and make mistakes in decision making. He also taught me that sometimes committees do even worse than individuals, and that committees might be led by a dynamic leader and everybody just follows the leader. So they make mistakes too that are not, the committee doesn't save you from poor decisions. So these are some of the things. I have more that I would say, but it's better for me to turn it over to Laurie Goodman and let her bring up some of the numbers. Laurie has a PhD from Stanford. She's in the Fixed Income Hall of Fame. She's been a fixed income researcher for several firms on Wall Street. She's now at the Urban Institute. I've used her materials for the last 20 years in my teaching because she does beautiful analysis, and I will let you hear from her about the financial crisis as well. And then after that, we'll sit down and we'll bring up Jeanne Flood and John Mack and let them talk more conversationally about their observations. Laurie, please, Laurie Goodman.
Doug, thank you so much for having me here today, and thank you all for coming. What I'd like to do is spend the next 15 or so minutes talking about how this happened. How did we get ourselves into this mess to begin with? And how exactly did the crisis unfold? So the outline of my talk is we're going to talk about affordability products and the expansion of the demand for housing, because after all, it did get started in the housing market. We're going to talk about the role of securitization and the rating agencies, how the crisis itself unfolded, and then the aftermath of the crisis. So basically, we begin with the expansion of the credit box. Essentially, home prices were doing very, very well, and lenders began to gradually relax standards. So just to give you an idea of the impact of this, let's say a borrower makes $50,000 a year, and assume that 28 DTI just for the mortgage payment is an arbitrary guideline. So that means he can afford a mortgage payment of $1,117 a month. On a 30-year fixed-rate mortgage using then prevailing rates, that would have been a home price of around $245,000. Now, if rather than a 30-year amortizing mortgage, you give that guy a interest-only mortgage, he could afford a home price of $291,000, assuming 20% down. So rather than having a 30-year fixed-rate amortizing mortgage, just doing an interest-only mortgage allows a 19% increase in the affordable housing price. So basically, home prices were doing really, really well, and you saw a huge increase in non-traditional products. So people were looking very closely at FICO scores at that point. Credit scores were absolutely constant during this period, as you can see from the top table. Meanwhile, let's look at the rise of interest-only products. In the prime market, they went from about 22% to about 92%. In the Alt-A ARMs, they went from about 20% to 85%. And Alt-A originally meant alternative documentation. It was for self-employed borrowers. Later on, it became, oh, this guy doesn't want to verify his income. Fine, he's Alt-A. There was very little, and we'll talk about that in just a second. Piggyback seconds, second mortgages, 47% of Alt-A ARMs, about 30% of prime ARMs, up from just about nothing. 40-year mortgages went from nothing to close to 30% in the subprime market. So again, subprime ARMs had very, very low credit scores to begin with, and we're giving these people 40-year mortgages to lower the payments and increase the affordability. And then documentation standards. And the definition of full doc was very, very broad at that point. Even so, only 22% of prime ARMs qualified, 57% of subprime ARMs qualified. Documentation of income was one pay stub. If you couldn't do one pay stub, you were no doc. So you had a huge deterioration in terms of credit standards. Appraisals, there was a ton of appraisal fraud, because after all, if your home wasn't worth what you said it was, what the appraiser said it was going to be worth, it would be worth that next week or next month. Don't worry about it. So basically, as affordability products continued their run, the home ownership rate went up. Home prices just continued to rise, and you can see that very, very clearly in this picture. And I think, one thing that nobody appreciated at the time, and we've begun to appreciate it later, is how all these things feed on one another. Home prices rise, so buyers are priced out of the market and delinquencies fall. Lending standards are relaxed further. Buyers can now buy homes. Home prices rise. Delinquencies fall, because after all, your home is worth more, so why would you ever default? Lending standards are relaxed further. More buyers can afford homes. So we were in this sort of virtuous mortgage housing cycle, and that was true on the securities side as well. This shows you the growth of the private label securities market. You can see that private label securities were close to 40% of the total market in 2005, 2006, up from about 15% or a little bit less in 2001. So the private label securities market grew considerably, and that was sort of the worst mortgages were in that market. I remember a conversation with the CEO of Freddie Mac in 2004, and he said, you know what? I'm just losing a tremendous amount of share to the private label mortgage market. I really don't want to relax my standards any further, but what am I going to do? I mean, what's the market going to do? And I said, well, this isn't, I said, you're going to either lose market share or you're going to relax your lending standards, and you should just be prepared to lose market share. It turned out that the GSEs did relax lending standards a little bit, but not nearly as much as the private label securities market, which is why that just continued to grow. Meanwhile, the securities market wasn't just the private label. Meanwhile, obviously these loans were securitized. So if you look at a subprime mortgage loan, that was then pooled together and carved into tranches. AAA, 81% of the deal, AA, 11%, single A, 4%, triple B, 3%, and double B, or not rated, about 1%. So you had these, and then look at that triple B tranche, 3% of the deal. That was then recarved into something called Mezzanine ABS CDOs, where you're taking basically something with almost no credit support, and then you're recarving it into senior AAAs, junior AAAs, AA, single A's, triple B's, and a non-rated piece. And then sometimes those bonds were repooled into something called CDO squareds, which was collateralized debt obligations of mezzanine ABS CDOs. So you had this whole huge infrastructure of securitizations. Now you're probably thinking, oh, a triple B bond out of subprime, how many of them can there be? if it's only 3% of the deal, and why should that prove to be such a huge problem? Well, in fact, we had $50 billion in mezzanine CDO issuance in 2006. Where did it come from? The maximum volume that should have been generated from the market was about $12.5 billion. How did we get $50 billion of this stuff? Well, the $50 billion reflects the fact that the balance was based on credit default swaps, where there was no actual underlying security. You simply referenced a real security. So it allowed for significantly more issuance in a shorter period of time than could have otherwise have been done. So you had this whole infrastructure of securitization that was quite remarkable. And the crisis starts. The Fed starts raising rates in 2006. Arm holders worry about payment shocks, and particularly on subprime arms. There's something called 228s, where the initial interest period was only fixed for 2 years. Many bought homes to flip and take out profit without considering the payments. Obviously, the poorly underwritten mortgages defaulted first because of fraud and lax underwriting. Liquidity dried up, the Fed started to lower rates, and you ended up with a vicious cycle on both home prices and security prices. So remember our virtuous cycle. Well, this is the vicious cycle, the opposite. Home prices fall, delinquencies and defaults rise, credit standards tighten, fewer borrowers can now afford homes, home prices fall some more, delinquencies and defaults rise some more, credit standards tighten some more, etc. This shows you what happened to home prices, down 32% nationwide from the peak. The home ownership rate fell from about 69% to a low of about 62%, but that took years and years to play out. Mortgage delinquencies rose. Delinquencies and foreclosures together had been about 4%. They were over 10% at the peak. Of course, on the lax underwriting products, they were much, much worse. On subprime, by 2009, they were 40% and rose a little bit more since then. On another product called option arms, which allowed for negative amortization, it was over 30%. So huge rise in delinquencies, and obviously huge downgrades in the securities market. So 2004 to 2007, AAA rated non-agency securities that were rated junk in 2011. In the subprime market, it was 99% of 2006 origination. But that was a long period of time. That was 2011. How did we begin to gather steam? Well, once home prices began to fall, you had price deterioration of the securities because the market expected prices to fall some more. You had margin calls, which caused forced selling and deleveraging. So remember, everyone was very heavily leveraged. So. For example, on a single A security, the haircut in May 2007 was 10%. It was 60% by September of 2008. So you get a margin call. The only way to meet that marginal call is to sell securities. Everyone's selling securities. Prices go down, which of course generates higher haircuts, forced selling, and more deleveraging. So you have a vicious circle in the securities markets as well. Fed intervention was, in my view, was a little bit late, but was very extensive. We support the Fed's, and as was Treasury intervention, federal intervention in general, small business, autos, financial markets, consumers, retirement, housing. And I must say that, you see each of these little bubbles, and a lot of times each of these bubbles is 4 or 5 programs. So for example, the Fed had something like 6 different financing programs. The foreclosure prevention and refinancing incentives consisted of 4 different programs. So the amount of federal intervention was very, very high. It began a little bit late, but it actually, I think, saved a situation that would have been a lot worse in the absence of that intervention. And the Federal Reserve used a lot of non-traditional tools. The words qualitative easing did not exist before this financial crisis. Cost of the crisis, we've talked about the $7 trillion in home equity lost and the $11 trillion in the stock market that was wiped out. But there was a huge human side of this as well. There were over 8 million foreclosures and an equal number of modifications. And had those modification programs not been in existence, a lot of those would have been foreclosures as well. And 8.8 million jobs lost from 2008 to 2010. So the cost of the crisis was huge, both in financial terms and in human terms. Thank you very much.
Thanks, Laurie. Now we want to bring up our entire panel, and we'll continue with some remarks first. I'll have Jeanne Flood and John Mack make their remarks, and then we'll engage all 3. Well, let us continue our discussion here, and I want to invite Jeanne Flood to make some remarks first. And let me introduce Jeanne Flood by saying that I first met him when he and I were on the faculty at Stanford with Ben Bernanke, actually. We were all junior professors, assistant and associate professors out of Stanford, like 81, 2, 3, in that range. And then Jeanne had gone to Harvard and then MIT PhD and then came to Stanford. But then he left and went to work for John Mack at Morgan Stanley from Stanford. So I think Jeanne worked at Morgan Stanley for 11 years. And then I brought Jeanne on the board of the company I started, Smith Breeden, and asked him to run it for me. So he became CEO of Smith Breeden, which is a money management firm. And he was doing that in the financial crisis. And I was following their progress quite a bit, and so I knew the pain that he had felt. So I invited Jeanne to come and to talk a little bit about that. And he first gave me a draft of some of his remarks, and I thought, you're not talking about the pain, Jeanne. Let's go back, and I want you to remember what it was really like in '08 a little bit. So anyway, let Jeanne Flood make some of his remarks. Do you have a slide that we can pull up that has his bullet points, I think? Sure. Jeanne, let me just turn it to you. What was your reading on the financial crisis, and what would you like to say about it?
Well, first of all, I want to thank you, Doug, for putting me in a place that was in the pressure cooker of the financial crisis. So I've got my good friend, Professor Breeden, here to thank for that. But also, I just want to, before we start, John, you may not remember this, but my introduction to Duke actually came through John Mack. And so, Doug, you had come here, but I'd never been here. And I was on the trading floor. The mortgage desk was right outside John's office when he was the head of fixed income before he became president. And so I used to see John all the time on the floor. And John came out one afternoon and said, hey, you want to run down to Duke? There's a good game tonight, and I got a plane. So we hopped on the plane, and we came down, and we saw a game. And that was my introduction to the Duke campus. So been around and worked with Doug and Alan Schwartz and many others here on the board. And then my daughter went here. And so she was at the class of 2014 at Fuqua. So been here for a long time. So
he's still dodging '08.
He's still, yeah. No. So, you know, as I think back about what happened then, you know, I think of it from the perspective of an asset manager, because that's what I was responsible for. There'll be people throughout the day, you'll hear different perspectives on what happened. But what I was doing was I was managing money for institutional clients. So as I think about what happened there and then what's happened since then, I think about it kind of through that lens. And it really falls into these 4 categories. Number one was there was just too much debt. Second thing is that one of the things that we learned, was that liquidity was episodic. And even in big markets, the liquidity could come and go. So much so that that really shocked us and made it difficult for us to do our business. Third thing was that there were important regulatory gaps, and so there was bad information and supervision, and that caused problems for us as asset managers. And then the last lesson was this human side of it, which was the importance of being present when there's fear and panic in the markets. And that's something that I'm sure we're going to talk about a bunch during the day. Let me just make a couple of points on each one of these, and then we'll go into more discussion. But there are a lot of things under each one of these. I'd say under this first point, why, as an asset manager, why did we really care about this too much debt? It was a very exciting time. As Laurie has described, there were a lot of new insights that were coming from academics and helping us with how we price contingent claims and so forth. But one of the big steps was this collateralization. And what it turned out that it was a two-edged sword. That on the good side, the good news about it was that that the loan origination could really bloom. And so that instead of all these loans, mortgage loans being held by banks alone, they could be passed into the capital markets. And so they could essentially be held by pension funds, endowments, foundations, other long-term money. So that was a good thing. The bad thing was that as that happened very quickly, there was accountability steps that were missed along the way. Poor information, as Laurie was describing, just became very prevalent. And the implication for us was that because there were a lot of these loans that were in there that were of lower quality than people believed, the loan volatility was high. Now, what that meant was the bond volatility that was sitting on top of those got very high. And as asset managers, we manage portfolios where we basically got bonds are supposed to be the safe stuff and stocks are the risky stuff. We went into a time where bonds became as volatile as stocks, and then we've got all of these people that have their pension funds, their endowment, their retirement funds in this saying, whoa, what's going on? My portfolio's all over the place. So it was introducing risk that was sending shock waves through the asset management market. So there's more stuff to talk about there, but there was too much debt, and that was one of the bad things. Was there was some good news that came with it, but there was bad news that came as well. This issue about liquidity, right? We've got to trade. We have to be able to turn over our portfolios as we're looking for places to put money to work. So we got to be able to have liquidity in the markets to trade. And what we saw as we went into 2008 was just a mess. It was terrifying because even in the biggest markets, liquidity was drying up. So in this mortgage-backed market, remember some of this stuff it was Ginnie Mae's. It was full faith and credit of the US government. In Fannie and Freddie, this was good quality stuff, right? The US said, we're going to step in, we're going to take care of this stuff. But there were big players in the market that were backing out. And so I remember as things started to get worse, we were going around the world and we were talking to the big pools of capital and saying, look, we need, this stuff is going to be money good, you should stay in it, and so forth. So we were down in Australia talking to the superannuation funds, right? These are huge funds, multi-$100 billion funds. And they were saying, nope, we don't want any part of this. We're stepping back. They're saying, holy smokes, because we've got there's a lot of capital that needs to be put to work, that needs to move. And we have to have players in the market. Get on the plane, we go over to Switzerland, Central Bank of Switzerland. I remember sitting there in front of the central bankers and them telling us, Jeanne, we're out. These portfolios that you're managing for us in these areas, get us out now. We don't want any part of this. Now, we've got huge portfolios, right? And we have to have players in the market where there's liquidity. Now, that is, as I said, that's the stuff that had US guarantees and US backing. Now, imagine now, as we go into the private label market that what Laurie was talking about. And I will never forget, I think of this as CMBS morning, right? Commercial mortgage-backed security morning. I came in and the panic was hitting, and these commercial mortgage-backs, right, they were commercial properties, but they weren't guaranteed by the government. They were guaranteed by private insurers. And as people said, these mortgages are not going to be any good. This insurance that's backed by these 5 different companies, they're going to get decimated. These people are going to be out of business. This insurance is no good backing these bonds. And so what was happening was all the people that held the CMBS were starting to sell it, and they were selling the market down hard. Now, what really got ugly was because of the derivatives market that Laurie was talking about, you didn't have to own the bonds to sell them. You could just short derivatives. And so the speculators came in and they sent the prices through the floor. And it was a bloodbath. And so those of us that own the CMBS and that own the derivatives, right, as the derivatives are going down, a lot of the people who own them had bought them on margin. And so we were getting margin calls as these prices were going down, and we had to come up with cash. And so we were calling some of the bankers in this room, and we were saying, we need cash. And they said, well, we can't help you. We're out. We've got to deal with liquidity problems of funding our own bank. And so this became systemic. And so these liquidity problems where they were big markets, big liquid markets, all of a sudden systemic risk started rolling through and all the doors started closing. And it didn't matter where you were. You fly to Australia. Sorry, Jeanne, doors closed. Go to Switzerland, doors closed. Norges Bank, Central Bank of Norway, sorry, doors closed. You know, our own banks in the US, same thing. So it's these liquidity episodes just became systemic. And I'll just...
Jeanne, could I clarify? CMBS are mortgages, commercial mortgages backed by office buildings, retail space, warehouse, and apartment buildings. So these have real assets behind them that are quite substantial, and it's just that these are loans on office buildings and all. That's what you were trading in, right?
That's right.
And yet people were trading them like they were just worthless almost. Yep. And this was like November 2008. Is that when that happened that you were talking about, Jeanne? Yep. Okay, well, go ahead.
So let me just say on this third point, the lessons, regulatory gaps. You know, what my view is of what regulators are supposed to be doing is that for the rank and file, you know, most of the people, the businesses that are working, they're honest people. They're trying to do what they're supposed to do. So regulators will, you know, kind of tuck things in around the edge, make things better. But what they have to do is they got to cut off the left tails. They got to get the bad guys out. And if regulators don't do that, they failed at what they're doing. And that's something that they were not doing during the crash. And so, you know, I remember, and this, you know, it still frustrates me to no end. When the SEC came in, and they came in every 3 or 4 years, and they do these deep dives, and they pull up everything, they look under every rug and so forth, trying to find what they call deficiencies. Right? They had gone through our shop and couldn't find anything. Now, we had one regulation in our internal, it's just a procedure in our internal manual that said, if you do anything with advertising with the mutual funds, it needs to go in this file, right? It's an internal procedure. So the SEC said, okay, So what did you do there with advertising with your mutual funds? There's nothing in this, there's nothing in the file. And we said, well, we sold the mutual funds a few years ago, so we probably should have taken that off. And they said, okay, well, where's the empty file? And they wrote us up. Now, there were bad guys and there were bad things out there happening. And there these guys are monkeying around with us on stupid stuff like that. And that's why I say it still irks me to no end that a lot of these regulators were just off base and they were doing stupid stuff when there was real work to do. Now, there were astute regulators that were really helpful. So Paulson got involved, and then when the Obama administration came in, Geithner, and then Obama was on top of this stuff. So, you know, in working with Ben, again, Ben was on top of this stuff. And I had one-on-one meetings with Obama. He called me, asked me to come in, talk about what was going on, and we talked. He was following all this stuff. He knew what was going on. We talked about the priorities. Same thing with Ben. I could call Ben when he was chairing the Fed. I'd go in, we'd sit, we'd talk one-to-one about what was happening. So there were astute regulators, and having those guys was really important, but there were big gaps. And then the last thing I'll just say is on these lessons of just have to be present. And with employees, with regulators, talking to them all the time, with clients, and whether these clients were sophisticated, they could be Central Bank of Norway, or they could be school teachers in Iowa, had to be in front of them and explaining what was going on. And then with employees. And employees, I tell you, it was just the hardest part for me because, you know, these are people, you know, they were your friends. These are families that you took care of them, right? I mean, you helped their kids go to school, you know, by paying them well, you helped them live well. And then having to say to these people as all this stuff was crashing and we were downsizing, firing these people who really, that you cared about, and they hadn't done anything wrong. All they had done was try to help, and having to fire them and put them out on the street was really, really tough. But as a manager, you had to be present and you just deal with the heat. Thanks,
Jeanne. John, it's your turn.
Yeah, I'm depressed. I'm going to go.
What's that? All right. The man who survived it, you're one of the, well, John Mack, of course, is a legend around here, and we're very proud of him at Duke. He's one of our own, and has come back and has been on the board of trustees and has served us in so many ways. And I'm delighted to see that Morgan Stanley made it through, and that price of $6 is now $44, and you know, everybody's, I'm sure, feeling a lot better. But you must have all kinds of stories to tell. I've got to think that you must spend a lot of money on a good psychiatrist or somebody like that talking about what you've been through.
Sure.
So can you give us your take on the financial crisis, John? And
yeah, I think Jeanne's really laid out kind of the big picture of what was going on. But I want to make some comments about interfacing with regulators. It became very apparent that the system was out of control. And I'd called Tim Geithner, who heads the New York Fed, a couple times and said, look, I can say no to one deal and maybe two deals, but on the third or fourth deal, if I turn them down, there'll be a write-up in the journal that Morgan Stanley is not active in the markets. Short sellers will take advantage of that to sell the stock short. And we had this conversation, and his answer to me is, well, you don't like my answer. I said, well, what is your answer? Well, you're not the first CEO's called me on this. We've gotten a number of calls. So my question then was, why didn't the Fed get active much earlier? And the reason they didn't, things were going along fine. And the housing market, from a political point of view, was very important. They were happy with it. But the signals were already out there. And in running a firm, it's very difficult to say, stop, we're not going to do that anymore. You have a lot of employees who are very active. Clearly, they want to make money, so they are taking more risk. And even though you tried to slow it down, which a number of firms did, it was a little too late. A couple of things that I just want to point out. We talk about a lot of different people in this There's only one hero in this. It's Hank Paulson. If it were not for Hank Paulson, I am convinced this whole system would have gone down. And he was the go-to person to get advice on what can we do with the Fed and with the politicians to try to avert this disaster that's coming down the rails. And you know, one of the things that we've not talked about, what's happening to the public firms, you don't talk about the hedge funds who are taking advantage, and look, that's their job to make money when they can, taking advantage of the situation that the public companies were going through, and just the public companies. And what would happen, just as the Fed window would close, you would see big shorts come on in your stock. We didn't have access to the Fed window. We just watched the stock drop. Next day it would continue, and we would try to get some kind of relief. So I would say that one of the reasons for that was the ability for active asset managers, and I would say mainly hedge funds, is to short our securities and also use derivatives. So I had a number of conversations with Paulson, who said, you got to talk to Chris Cox. Chris Cox was head of the SEC. So I called Chris Cox, and we had a conversation, and he said, there is no academic study that shows that short sellers could drive a market down like this. And I said, Chris, this is not a fucking academic study. This is real time. And one of the reasons I say that Paulson was a hero, he got Chris Cox to finally freeze this ability of all the shorting that was going on. Now, the other side of that is the hedge funds were angry that, you know, he did that. And I'll never forget, my trading desk came to me and said, I won't give his name, XYZ will no longer do business with us. I said, well, why? He said, we don't know. So I called this large hedge fund, who's a very active account, and I said, you know, I'm told you won't do business with us. And he said, I won't. I said, well, tell me why. I said, you cost me $190 million. Well, I said, well, that's interesting. How did that happen? Well, you got Chris Cox to stop, put a ban on short selling. I said, well, do you think I have that much power? He said, you're really influential. I said, well, let's just be clear. If I could do it all over again, I would have done it a day earlier. So what's missing in some of this, because of private equity, or call it hedge funds is a better term, and look, their job is to make money. They took advantage of the system big time and put a lot more stress into the system. I don't fault them for it. They have a fiduciary responsibility to do well, but you also have a responsibility, I think, to do what's best for the country. So those are some of the things that really stick in my mind. The other things that stick in my mind, we brought our board in over the weekend. We did not think we'd be able to open the doors on the next few days. And at the same time, we had reached out to a number of people in Europe, in the Middle East, and in Japan and China. Morgan Stanley had a great relationship with the Sovereign Wealth Fund in China. Wang Qishan, who's now vice premier, and I are old friends, and he ran it. And they came to New York, and they had made about a $500 million investment in the firm 18 months ago or 2 years ago. And I don't know if you've negotiated, but a lot of people, especially a lot of the Chinese that I work with, they like to negotiate. So in the first time, we were not in any pressure, but they wanted to have some piece of Morgan Stanley. We had done a joint venture with them in China. So it was going to be a negotiation. But what I didn't understand is how much they like to negotiate. So you come into the conference room, let's say you can have 20 chairs in a row, and the Chinese sat at one end. We sat at the other. And during the course of a day and a half, we got to the middle and we did a deal. And they bought their $500 million in Morgan Stanley stock. Now we're on the verge of going out of business. So I called Qishan, and he sends a team to us. This time, he's already at the far wall. I'm in the middle of the table. I need to get a deal done. And we go back and forth, and as a result, we don't get a deal done. We've reached out to the Japanese, and something all of you should remember, that relationships are critical. So when I joined Morgan Stanley in 1972, there were 180 people. I guess that's me. I think that's you. That's all right. 182 people, and there were 3 Japanese citizens from either the insurance companies of Japan or the banks. And they were trainees. They would walk around, sit at a trading desk, sit time in investment banking, et cetera. So our office in Tokyo calls and says, Mitsubishi has interest in talking about helping you out in this crisis. So I jump on a plane, I fly to Beijing first, and I see Wang Qishan, I see the vice premier, and they won't budge. And I would say they were antagonistic, which is fine. I get in the car to go now to Tokyo, and the phone rings, and it's Wang Qishan. He says, look, John, I know you got beaten up. You got friends here. Just get this thing settled. We will be here to help you at some point. Not immediately, but at some point. Go to Japan. We had put a transaction in front of them. How much Morgan Stanley they could own, what we could do with them. So I wake up the next morning, I go in the meeting, and Hirano-san says, Mr. Mack, since we've agreed earlier to think about putting all this money in, your stock has traded down another 20%. So we think it has to be a lower price. So in my mind, I'm saying, this is the retrade, which happens a lot. Said, well, I'm halfway around the world. I can't give you an answer. Let me get back to New York. I'll call and we'll talk about it. Get back to New York. I go to the head of our M&A department, a guy named Paul Tauman. We sit down, look at their proposal, and he said, you know, John, if we change the maturity structure slightly, they can keep the same price but get a much better yield. So Japan opens. I call Hirano-san, and I said, Hirano-san, I will do the deal as you laid it out. But would you consider this? And I gave him an alternative. End of the day, he calls back and says, when you're about to lose your, I'm saying this now, when you're about to lose your firm, you get really emotional. I'm getting emotional. He says, out of respect for you, you choose. Which is unbelievable. I go down to my M&A department and I say to them, what does that say about us? We'd have taken the last penny off the table. The point of the story is relationships in any business, but especially financial service, is really important. And trust is really important. And that's what we built with the Japanese in 1972, and it carried over. And without them, I don't think we'd be in business. They wrote a check. It was a holiday in the U.S. Banks were not open. They wrote a check for $9 billion and handed it to me. It was, in looking back, it was astonishing. At the time, it was unbelievable. And what's happened from that ability to have trust and have a culture, which we had at Morgan Stanley and Mitsubishi had, we were able to become the dominant player now in Japan. Because with their relationships and what we brought to the table to help them build their businesses, it's been a home run. So we got very lucky on it. I think as I look back...
John, when was that?
Well, that was during the crisis.
So that was after Lehman failed.
Oh yeah.
After Lehman failed, then
exactly.
You felt the pressure, and that's when.
Yeah, it was one, they were going one at a time, which
that's what
I don't blame them. That's exactly what was going on.
So this was later September.
Yeah. So I guess that's really it. I mean, we're happy if we have time for questions to ask them. Go ahead.
We'll keep going here a little bit before we open it up in general, but that's pretty incredible, John, what you just described there with the Japanese and the $9 billion. After that, were you then out of the woods pretty much, or did you have some more battles to fight then?
No, that really saved us, because what it did, it let people who were putting a lot of pressure on our shares that we had a deep pocket and they were involved now. And it gave us kind of the financial strength to get through it, and then things calmed down.
I'm sure a lot of people have seen the movie Too Big to Fail. And John has already said some very nice things about Hank Paulson, who was treated well there. I got a kick out of the way they introduced you, and I was about to play that clip. It's something like, "There's blood on the street, let's go kill someone." And Mack said something like that. Did you ever say anything like that, John?
Probably.
Probably, yeah.
Listen, we all have to mature. It took me a long time to mature, so I would say things like that.
But do you think the movie was reasonably fair on some of the dynamics there?
Yeah, I think they did a good job with it.
You know, one of the things they had, I remember this, and it was kind of an amazing scene in the movie. They had Geithner basically at one point trying to put banks together and say, let's merge these investment banks with commercial banks. And I think they described that they wanted Morgan Stanley to marry up with JPMorgan. Right. And they had a scene in there where you were talking to Jamie Dimon. It's like, do you want to do it? No, I don't want to do it. Something like that. I don't know. Did that really happen?
That really did happen. And he said the only way I would do it, I'd pay you $2 a share.
Really? Yeah. Is that
it? He didn't want to do it. And he said, I'm going to call Tim and tell him to stop putting my name out there, because everyone was having problems. And even though they were a fortress bank, they were all having problems, and he was right in it with the rest of us, but not as bad. It also had, you know, to have access to the Fed window was really important. And for ourselves and Goldman and a few others, we didn't have that. We did get it during the crisis. So there was no game plan. It was like, all right, here it is the next hour. What do we need to do? And again, I take responsibility for the pain and suffering of Morgan Stanley and what my employees and shareholders went through. And I think every CEO has to take on that responsibility. But given the ability I'll call it manipulate and short securities and use credit derivatives, I think that was just pure greed. I understand it. But at some point, you got to put on your USA hat and say, what's the right thing to do? And I didn't see a lot of that.
I wonder, what do you think about the Fed's handling of Lehman? It's like, should they have gone in with some support like they did for Bear Stearns' JPMorgan deal and essentially saved Lehman? There are many people who seem to think that it was a mistake to let them fail. I wonder what your view is on that.
Well, Dick's a personal friend of mine, so...
Dick Flood,
yes.
The head of Lehman.
And I did call him if he would come down.
Did you? Okay, John, when I talked to him, he said, Dick Flood might have a little bit to say. We ought to get him down here. I said, if he'll come, we'll put him on stage. But it was too late, I guess. Anyway, go ahead. What
I think Lehman was, and if Dick were here, I'm sure he would argue with me. I think they were more aggressive. Bear Stearns and Lehman were the most aggressive in the marketplace in mortgage securities. One of the reasons is that was kind of their bailiwick, where if you went to a Goldman Sachs or a Morgan Stanley, they had very strong investment banking and a lot of relationships around the world with corporations. I'm not saying Bear Stearns and Lehman didn't, but they didn't have as many. And I guess in Paulson's view, we don't need to stand up and save this company. Now, if Dick were here, he would say that Hank and Goldman has had it in for him for a long time, which I don't blame him. I would say that too, if it's true or not true. I just throw it out there. But if you were going to lose two firms, I think which is tragic, those were the two that had to be sacrificed.
Well, it'll be interesting to see what Alan Schwartz has to say at the end of the day about Bear Stearns there.
You can tell him I said that.
Can I take a slightly contrary view on the Lehman issue? I actually think that Lehman should have been forced into a sale where the management was not saved, but because I think the crisis was a lot deeper because they were unwinding so quickly. And I think, if there was one mistake during the sort of one of the arguments for letting them go is, well, gee, everyone will assume they can take risk without limit. There's a huge moral hazard problem. I think during a crisis, the moral hazard argument came up time and time again. It came up in terms of the Lehman bankruptcy. It came up in terms of the design of the home affordable modification program. So principal forgiveness was not part of the menu until much, much later, and even then very marginally, because after all, we were very, very concerned about moral hazard. I think in the midst of a crisis of this order of magnitude, you have to actually be willing to live with a certain amount of moral hazard.
Yeah, but at that time, they thought there was a deal with Barclays, if you remember. Do you remember that? Barclays Bank. And that fell apart at the last minute. And I can't speak for Paulson or anyone in the Fed. I think it was too late by then. I mean, the destruction it had taken, when that deal was announced that it fell through, it just took another slide down. But you and I disagree on it. At some point, you got to pay the price, and they did.
I wondered on the moral hazard issue, as I think of Bear Stearns going from $160 down to 10, I think of how many millions their top executives must have lost, and wonder, would people really want to take that chance again going forward? I mean, is there a big, moral hazard is basically where we're saying, okay, the managers will want to take big risks because heads they win and tails the government loses, okay? Taxpayers lose because they bail them out. But they didn't bail out all the top executives who must have lost, I don't know, John, I've got to think that your net worth must have fluctuated quite a bit.
That's why I can't give money to Duke anymore. I've lost so much.
Exactly, and Alan's as well, and a lot of your people probably. Your managing directors, did they own Morgan Stanley stock or have shadow equity there? And I presume they were hit really hard. How do you think they manage the firm today, and how were they affected by the experience of the financial crisis?
Well, I think the real impact, and you have other CEOs who in financial services are going to speak, the real impact is what the boards did. The amount of time now spent on risk management and making sure that we even bring outsiders to sit on some of these risk committees with the board who are experts supposedly in risk management. So the big change is how boards have adapted to this risk environment and how important the whole audit function is and the risk management function is. And I would say it's been 10 years since the crisis. If anything, that scrutiny has been increased, not decreased. And that's been a very positive step.
Well, I wondered how you felt as a manager about your risk management and the calculations, because what actually happened must have been so far worse than what most institutions were simulating. Jeanne, you probably saw this as well, with where people estimated value at risk, the amount that you could lose. And I remember talking to Bob Merton about that for long-term capital one time, and he said we were simulating that we could lose 35 million here, and then we got hit by 500 million. Like 17 sigma or something like that when swap spreads blew out in '98. You must have had that kind of experience. And Laurie, I don't know, did you get involved in that? I just wonder, what do people think about tail risk? Tail risk, I guess, is what I'm talking about. How we simulated that. Did it catch us by surprise? It had to in a big way. Jeanne, did you want to comment there?
Sure. I think one of the big changes in analysis was that people are doing much more scenario analysis now than they were before. So rather than just trying to rely on a distribution and say, here's the probability of this, probability of that, it is more, the analysis is, if we get into this state of the world, what's it going to be like? If we move to this state of the world instead, what's it going to be like? And so this state analysis has become very important. But I want to just emphasize one of the things that John said is this change with boards and how boards are dealing with risk. So we have these risk committees now, or these risk teams in all the firms. So a lot of times what you hear now about is first line of defense is the frontline people. Second line is you've got these risk management teams that sit behind them or with them. And then third line is the audit function or any types of external risk management that comes in. This has become very important, and regulators all over the world are pushing really hard on it. And so they want to come in, they want to see this scenario analysis, and they are pushing these management teams, but the boards as well. So I'm on the board of Janus Henderson, which is a global asset management firm, and I chair the risk committee. And so risk committees now are facing off against not only pushing management, being pushed by shareholders post Dodd-Frank, but now also we've got shareholders that are coming directly to the board. So half of risk committees now in the United States have been contacted directly by shareholders and pushing us on questions like, how are you challenging management on tone from the top? What are the metrics that you use to assess tone at the top? How do you push back? How do you assess the pain points that management's dealing with, and so forth? And so this is something that's really new. I mean, this is something that certainly before SOX, you would never have seen. And then even in the crisis, I think there was very little of it, whereas now it's becoming much more commonplace.
Yeah, let's
Laurie?
talk about
Sure.
risk management during the crisis. There basically was none. So Wall Street trading firms had a caste system that was even more severe than high school. The traders were on top, followed by the salespeople. Research was a distant third. That was me. Risk management.
It was fourth. Research was fourth. That's all right.
Risk management actually ranked below research, and operations was the bottom of the pile. But there was and you knew your place in the caste system very, very well. And in fact, everyone was basically paid by the trading desk one way or the other, including risk management. We were nominally paid by the firm, but the traders actually were asked, but the trading desk had to make a contribution to our bonus because they were the only profit center, and if they didn't like it, they reflected it. Risk management was paid by the trading desk, so everyone was essentially paid by the trading desk. I remember there are two things that sort of stand out. Once is when one of the risk management people comes to me in the midst of the crisis. It's like late 2006 as prices were beginning to deteriorate a little bit. And the guy that traded option arms had marked all his positions over par. And she said, over 100. And she said, well, what am I going to do with this? This is clearly wrong. I said, did you go back to him? And she said, yes, he wouldn't change it. He told me to go away. Actually, he didn't say it quite that nicely. And I said, well, you got to go back to him. It's just plain wrong. And she said, I can't. I've been back 3 times. I just don't want to look like an idiot. What should I do? I said, well, you can combine these 2 categories of arms together, so at least you'll get the price under par. And she's like, oh, that's brilliant. That's brilliant. That was not the right answer. But and then the second thing is, in December of 2006, as prices were beginning to decline, we did a little simulation on some of the CDO positions that UBS held, and it was a huge position in CDOs, and we showed that under pretty severe scenarios, or situations that we considered pretty severe but not out of the question at that point in time, AAA CDOs could take losses. So, of course, we show our publications to the trading desk before it goes out. The trader said, you can't publish this. These scenarios are ridiculously severe. I said, is the analysis wrong? And they said, no, your scenarios are just too severe. So we always went through, this was something that we did every Tuesday evening when we published, where the trading desk would read our article at 4 o'clock, say no, and we would go through the Solomon, divide it in half. Okay, well, you can say this much and you can't say this. So in the end, we ended up publishing the table and sort of taking out the couple of paragraphs that said, under not unreasonable situations, AAA CDOs could take losses. I was kind of upset because this is an article we had put a lot of time and effort into. It was a complicated simulation. So I went to our risk management people the next day and I said, listen, you know, we took the conclusion out, but I hope you saw this table, because it basically, we have a lot of positions here, just wanted to make you aware of it. And they're like, the traders say it's fine. Wow. I'm like, but traders say it's fine. Goodbye, Laurie. And that was my conversation on AAA CDOs with our risk management folks, because again, everyone was paid by the trading desk, totally misaligned incentives.
Wow. That's amazing.
And the traders in turn were paid on their marks.
Yeah, I've got a question.
Yeah, sure.
Let me ask John. John, during the crash and right after that point, with clients, what kinds of conversations were you having with clients at that time?
Yeah, well, most of the conversations were much more with shareholders than with clients. Whether it was a large pension fund or sovereign wealth fund or a small money management firm, those were the conversations. With clients, you know, I guess what they really wanted to know, are you still going to be in business? And we could answer that question, thank God. But I didn't have a lot of engagement with clients saying, give me a rehash of what happened, or what are you doing differently? Mm-hmm. If it came up as in a casual conversation, it wasn't a specific meeting to talk about our risk management.
I see. And then with shareholders, aside from the big ones that you were talking about, what kinds of conversations were you having there?
Well, clearly with the large ones, in-depth conversations, and talked about our risk management procedures and our oversight of risk and the independence of the risk committee. We did have our risk committee come to our board meetings after, because we didn't want them just to hear from the head trader. We wanted to hear the risk committees come in and talk. You know, it wasn't very many conversations, not a lot of depth in those conversations. Mm.
You know, I feel like now we can perhaps turn to questions from the audience, if that's okay with our panel. And I do want to recognize also two people right up front here who are our good friends, Rick Wagner and Gerald Hassel, who are on panels later on today, or on the same panel on where do we go from here. Gerald ran the Bank of New York, Rick ran General Motors, and they have a lot of experiences too. Do you have any questions for these panelists, or you want to hold off on that? Yeah, John. Yeah, Gerald lived through it with John there. All right, let me open it. Yeah, Rick. Yes, you have similar nightmares as well. I suspect they all keep counselors well paid. What questions do we have from the audience? Any? Yes, please.
Over here. John, if I recall, a lot of the banks were, pretty much all the banks were forced to take hard money, and perhaps some were reluctant to do so. Do you, in hindsight, do you believe that all of them needed to take hard?
I do. And that was an interesting meeting we had at the Fed. It was Jamie, myself, Vikram, and whoever else was there, I don't recall. The Goldman guys were there for sure. And Hank Paulson said, we've worked together with the Treasury, here's TARP money, and I want all of you to take it. And here are the restrictions that you have to work under TARP. And then he ended and said, and if you don't take this and you screw up, I'm going to punish you. So I took it, signed it, and flipped it across the table. And Vikram looked at me and said, aren't you going to take this to your board? I said, fuck no. When the head of the Treasury says he's going to punish us, you sign it and move on. And that's what we did. Again, I said it earlier, I'll say it again. Hank Paulson was the hero. And the TARP money was very important. And over time, you could pay it off, which we all did. And we had to pay up to pay it off, which we did. So we all took it. No one turned it down.
Next question. Yes, please. Please speak as loudly as you can, or do you have a mic there? Okay, we have a mic.
All right. So I work at Raymond James, so a little bit off of Wall Street, let's say. In regards to the caste system that you were speaking about, do you feel like that still exists? And, you know, is it the shareholders that are elevating risk management to a different level in that caste system, or who's kind of changing the dynamic there?
Well, I think a combination. Clearly the board is making a change. But also the Fed comes to a board meeting, I've been out 10 years, they would come on a regular basis and sit with the board without management and talk about issues and what are you paying attention to. So the ability of regulators to drill down and get inside the boardroom and talk to directors had huge impact on risk management and the responsibility of the board and the independence that we needed in risk management.
Yeah. The independence is key. I think now, in no cases, does risk management work for the trading desk.
That's right.
Okay, we have another question. He's bringing the mic to you right now. There. Okay.
Hello, thanks for today. Kenny Turner, alumni, 2001, I think. So this is all very interesting. So how do you fix it? I know there's a session later today. You talk about the, too much debt and leverage. One could think that one way to fix it is you don't allow leverage, but that will stifle the economy. But so how, I know there's a session later today. How do we go about fixing this? And also, how do you regulate innovation? Right? It always seems to me that the regulators will always struggle and always lag innovation in regulating innovation. Love to hear your thoughts.
Well, it's a great question. I think one of the issues for all the financial firms is this ability to innovate and come up with a new structure, and how do you evaluate that risk? I think the only answer is there are more and more conversations, as I said, where the Fed comes to the board meeting and your risk committee's there with the board, and you can have those discussions if you are going to try to innovate, and what does the Fed think of it? Again, being out of it for 10 years, my guess would be, and maybe Jeanne will have the same insight, that you actually go to your regulator and say, here are the changes we want to make, and get approval. The pain that people went through 10 years ago is still as real as it was if it happened a year ago. So boards are so focused on these issues, and now the work that the board does in getting the right board member who brings some of these tools to the table, and then using consultants. The boards are using consultants to help them, in some cases, understand these products. So I think innovation gets a lot more scrutiny today than it did 15 years ago when I was at Morgan Stanley.
And yeah, I would add to that, Kenny. I think one of the things one of the advancements that we've made here since the crash is having the regulators really get much closer on what are the incentives inside the firm, and then how do does management have the right systems set up for compensation, risk management, and so forth, so that things don't go off the rails? And so I think regulators are doing a better job at that. And I'd support what John said. So for example, with Janice Henderson, right, the head of risk on management reports solid line to me, the chair of the risk committee on the board. Right, not the CEO, and dotted line to the CEO. Likewise, on the audit side, we have the head of the audit function reports solid line to the chair of audit on the board, and then dotted line into management. And we really work hard with these groups. And we're trying to be cutting edge. So let's see, what's today, Monday? Wednesday.
Okay. I was worried about my memory, thank you.
What country are you in, Jeanne?
Yeah, stuff is a blur. Yeah, it's too much, it's still shell shock from what's happened before. But so, last week I was with Ben Gullub, who is the head of risk at BlackRock. And so we spent time together in New York talking about what's cutting edge in risk and how is that managed. Ben and I were classmates at MIT, so we know each other, so we're talking deep. Then I'm going to the next place, the next place, the next place, going around the world, putting together who are the best people in risk in the world that I know of, and how do I bring that as chair of risk of Janice Henderson to our team and push them on it and pull them out and bring them with me to some of these things and so forth. So, all of that stuff is going on, and it's at a much higher level now than it was when I was managing.
Laurie?
I was just going to say one thing. So sometimes when you regulate one thing and you don't regulate another thing, you end up with issues that you didn't anticipate. So, for example, the mortgage system has changed dramatically. Loans are safer now, which is a really good thing. I think, obviously the market did this before the qualified mortgage rule, but the qualified mortgage rule institutionalized no interest-only loans, no loans with negative amortization, et cetera. One of the legacies of the crisis, though, has turned out to be, the Department of Justice has sued a lot of the banks for under the False Claims Act. That is, if you lie to the government, you are subject to triple damages under the False Claims Act. This was a Civil War era statute, and it was meant to combat people who were selling mules to the Union Army claiming they were horses. It was meant to combat the use of a material called shod for uniforms that dissolved in the rain, not a very cool characteristic of a uniform. And so if you, hence the word shoddy merchandise. But anyway, it was a Civil War era statute that had never before been applied to financial services. It started to be applied to financial services, and in particular FHA loans in 2011, 2012. The banks have totally pulled back from this market, so it's basically a non-bank market. And there's actually some servicing issues where there's actually a considerable amount of systemic exposure. If you were to get a sudden rise in delinquencies, a lot of the non-bank servicers who have essentially no prudential regulator would probably not survive. And I think, sort of when you're looking at the system, a lot of times, I don't think the intent was to drive almost all the banks out of the market, but that is essentially what has happened. So I think you have to actually take a close look and say, well, gee, obviously higher capital, very, very good thing, but then, have we pushed things a bit too far? And in this particular area, I think we have.
Well, let me ask you a question. Just listening, what could come down in the future? More and more financial technology is taking place, whether it's lending home or a lending club or whatever it may be. Are you aware of any regulatory oversight for these fintech companies who are in the financial service area?
There is very, very little. And actually the interesting thing is that there have been fintech innovations in terms of making the mortgage process more efficient, but there's which is a good thing, but then you look at what the lenders are doing, and what you find is that the fintech lenders aren't an equalizer. They're actually skimming the cream of the crop. That is, they're taking the highest quality borrowers, charging them a little bit more because you can get your mortgage application done at 3 a.m. and therefore you don't have to take precious time out of your day. And they actually, rather than being an equalizer, have the highest quality candidates, which is something that you don't see in any other area of, you don't see it in lending, you don't see it in consumer lending, you don't see it in any other aspect of fintech, and it's actually quite interesting. And I mean, a lot of it is the system is so fragmented so that those who are underwriting are not actually getting the benefit.
Right. Yeah, I would think, Doug, that might be something that a few people could look into or think about. Fintech's just exploding. I sit on one of the company's boards. I'm not familiar with the audits that we had in the banking industry. I know it's different and it's small, but they're going to grow as we go forward with technology. It could be an interesting study to do or look at.
Yeah, I think another part of that that's quite interesting, that's evolving quickly now, is we were talking about lending here, but the payment system also is moving more and more out of the hands of the Fed. And so the payment system, whether it's Apple or whoever, you know, there's lots of people that are getting involved now. And so transactions are, especially now given with the advent of blockchain, you know, transactions are going to be off the radar of at least what the Fed can see now. And so looking at the evolution, the future evolution of the payment system and how that could be regulated is something I think would be quite interesting.
I wonder, does anyone have comments on Bitcoin? When I think of that, I remember, I think Jamie Dimon said he'd fire anybody who traded Bitcoin at one point, and then he seemed to back away from that a little bit. But I noticed that it's down to like $4,000, and wasn't it up to $18,000 or $20,000, and it's down to $4,000 now. Anyone of our panelists have a comment on Bitcoin?
I don't have a comment other than I own Bitcoin because I don't understand it, and I want to try to learn it. But it's like going to Vegas. You know, let's put it on red and roll the dice.
Exactly.
I actually, you know, I think about that whole sector, the digital sector, as currencies, digital currencies are part of it. But that's a broader sector, and I think it's the payment system, it's these other parts of it that all will be this stuff that's driven by blockchain technology. And I think it's going to become more and more important as part of the economy. You know, at first, when I looked at it, I thought, okay, well, maybe something like these digital currencies would be useful for countries that have problems with their fiat currency. And so that people that don't have access to banking can get access to banking this way through their mobile devices and so forth. And they don't have to rely on their unstable fiat currency, Argentina or whomever it is. But if you look at, you just take the United States, you know, so why is it that if you've got a Fed wire to do, that it has to stop at 5 o'clock? You know, there could be transactions that go on through the web with blockchain that happen any time of day or night, et cetera. So you can march down this. And so there's branches that take you to that becoming central in our economy, not just for underdeveloped countries or something.
Getting near the end, there was one question I had. Well, let's first take one up here rather than mine. Yes, please. Can we get the mic up to him?
Hey, thanks for coming today. This question's for Mr. Mack. I was wondering during the crisis, besides running around with your hair on fire trying to exit all the positions, what was Morgan Stanley doing to take advantage of the crisis? Were they shorting other banks?
No, it was about survival. We were not shorting other banks. What you're trying to do is get your positions to a neutral position. I mean, the perfect position would be long and short the same amount of risk. So I'm not aware of any trading desk said this is an opportunity to make a lot of money. This was about survival, and that's what they focused on.
You know, the question I was going to ask was what worse things, even worse than what we had, could have happened? For example, if Paulson, Bernanke, Fed hadn't taken strong action. You know, I'm sure we didn't go to the absolute worst thing that could have happened. John, Laurie, any comment on what could have happened? John, you were staring at it in the face so much with up close. I mean, as you described, that Morgan Stanley, if it weren't for the Japanese investment, might not have made it, I suppose. And so there must have been another scenario that was even a little bit worse.
Well, I don't know if it's worse. The other scenario is Jamie could have had the firm for $2 a share.
I see. Okay, he could have had yours too. Laurie, any thoughts?
Yeah. So you know, when you sum up the financial crisis, there was about 8 million foreclosures, which is a huge number. But there were an equal number of modifications. Had those modification programs not been in effect, it would have been a lot worse. I mean, I think, you know, certainly the HAMP program came into being in early 2009. Yes, it should have been earlier, but it wasn't. But I think that, you had over 8 million modifications.
So describe how that worked.
Okay, so basically
generally.
the Home Affordable Modification Program was a program by which borrowers became entitled to a modification under a certain set of circumstances, and generally it resulted in a lower payment on that mortgage. And if you could make the lower payment on that mortgage, you were able to keep your home. And you sort of say, well, why should you give a guy who can't pay his mortgage a break? And the answer is because if you go to foreclosure in a deteriorating housing market, it is very, very expensive. The transactions costs of foreclosure are on the order of about 30%. So if you can give someone a break on their mortgage payment and they can continue to make their mortgage payment, that's better for everybody. It's better for the borrower, it's better for the servicer, and it's better for the investor. So yeah, I think that was actually a very, very important set of actions on the part of the Obama administration, and it's left a very lasting legacy.
It's also better for the neighbors of the people.
And it's better for the neighbors, yes, because nothing is more devastating than having a ton of foreclosures on your block.
One other thing that is a central topic of one of our last panels is, could this happen again? And I didn't want to make that a big topic for this panel, but in the last minute, could it happen again? Laurie, John, Jeanne, and we'll end with that.
Well, if you look at history, the answer is yes. I mean, it might be 100 years from now, but there will be some financial crisis at some point again, and whether it's driven by the new technology, fintech, or some other event, but the answer is there'll be another crisis.
Laurie?
Yes, but it won't be in the housing market.
Won't be in the housing market. It's interesting because of the new rule that banks have to qualify so that you can pay the loan back?
Because I think we've just become so much more aware of the risks. Loans are sort of permanently better now. The risky features have basically been eradicated by legislation. So I think there will certainly be another financial crisis at some point, but the housing market will not be the epicenter from it.
That's good to hear. Jeanne, any comment on that?
Yeah, I think the answer is almost for sure yes. I don't see how you could avoid it. Innovation happens, and it's always going to happen, and there will be unintended consequences of some of these new ideas, and they will slip through, and there'll be too much of them. And then human beings are human beings. There's herd behavior and there's fear. And each time there's a crisis, it's driven by that. It's a different technology that's underlying it, but it's the same thing. And so my expectation is it will happen again, and all we're trying to do right now is we're trying to close as many doors as we can, but we know we're not safe. All we're trying to do is see if we can push it out a little further and make it not as bad.
Okay, with that, I think our time is up. Please join me in thanking our panel.
Thank you.